Hey Alpha fam, welcome back to another episode of Alpha Commission. Today on Alpha Commission, of course, I'm going to go over the Bitcoin chart, but guys, of course, we also need to understand the system that I've been putting in front of you every day. And of course, this is something that's proprietary that I have developed over the last year and a half. And if you're inside of the Alpha group, you understand where that evolution came from, and you probably have a pretty intuitive feel of, what these different levels mean. However, for those who are just joining us in this market, maybe it's not 100% clear where these levels are derived from in terms of price action. Now, of course, the system that I've created is a momentum and volatility trading system. Okay, so we're looking for volatility, right? Expansion or contraction of price action. And we're also looking for momentum, right? Basically, trend and continuation. And so, guys, when we put these things together, essentially, we are going to have, interactions in price, which then imply a key inflection level. And these levels may change day to day based upon that day's price action. And that's why the levels are valid at the end of the day, at the close of the day, when it's a daily chart that I'm presenting, because we want to see where price action lands relative to the key levels, those inflection points, so that we can make a decision in terms of the statistical likelihood of price action going forward. And so here's a chart that I made yesterday. Okay, it's for the close yesterday there, and what you can see is that I had a hold momentum here, right? A hold momentum level here. Essentially, that meant that if price action didn't violate the bottom of this candle, right? We didn't close underneath that candle, we would hold our current momentum. Additionally, if we had not only violated the bottom of that previous candle, but we had also engulfed its wick, right, and pushed even further down on this candle right here, this dramatic candle that, in terms of price action, pushed us up into this new territory, crossing this resistance bar that we had here, just cutting through it like a hot knife through butter, then that would imply that we were going to lose the momentum here. We were going to engulf this candle more than 50%. We were going to have a little bit of a buffer room there, just in our own discernment, okay, where that inflection point might be, given the little bit of jitter in price action that's possible. You see this wick right here. You see this little tiny wick right here. So we have to have some type of buffer area. That buffer area of ambiguity, where we're not 100% sure what's going to happen next, is the momentum pool. In other words, you can front run a short from that level if you believe that this chart has topped out. If you believe that we have hit some key resistance, then it could be suggested that if we lose our hold momentum, well, imagine someone dangling off of a cliff and they lose their hold on the edge of that cliff, they may just go plummeting, okay? And that's what the hold momentum level represents, that firm grip on our current price action. And then the add lose momentum level is where an arbitrary EMA placed across the RSI is going to cross in order to convey to the user of that indicator, right? And again, we can define these variables ourselves. Okay, some people might use standard numbers. I like to finesse my numbers to something that I find that is relevant to the chart. And so when I'm working with my indicators, I choose values that are important to me, that I have found in the past are statistically relevant, and that show, the proof in the pudding, essentially. At the end of the day, they work and they continue to work. And so where I designated that EMA, the length that I designated for that EMA across the RSI is where I consider the RSI to be breaking down. Now, that doesn't mean that it is a bull zone or a neutral zone or a bear zone on the RSI. It simply means that I have a heads up that the RSI is breaking down at this add lose momentum level. In other words, this is our front runnable zone. So generally speaking, our trades are going to be made off of the alpha momentum pool. And since we're using a momentum tactic, one thing that we can see is that we have a strong momentum to the upside, right? This is obviously a strong trend, a strong momentum to the upside here. And then we have a change in momentum, okay? It's not necessarily a change in character of the price action, but it is a change in the momentum. Instead of these just straight up candles, we are now having a pullback. And unfortunately, we didn't close any candles, or fortunately, if you're long, but unfortunately, we didn't close on any candles under this hold momentum level. And so it is not implied that we are losing momentum. This trend, this push, this momentum to the upside still has the possibility for continuation. However, had we closed the candle underneath the previous one inside of the pool, and definitely, had we lost momentum by crossing the EMA on my RSI, then it could have suggested that we go for a deeper retracement because we are significantly losing momentum. Now, what is this general continuation level that I have here? This is a level that is designated by the MACD, okay? Now, there's a lot of MACD traders in the momentum trading community. And so their opinion on where the chart is firm and their opinion on where the chart is showing weakness is important. We have to consider the MACD traders. The MACD is one of the most popular tools used in trading. And so there's a significant amount of algorithms and bots and just momentum traders that are using the MACD. That's why I call it general continuation. Above that line, there's still a chance that you're pretty secure. Below that line, there's a good chance that the market is going to start turning against you for something that may be deeper than what you had first expected in just this kind of shallow pullback here. Now, if you were to use fibs, right, you would probably find that we're in a shallow pullback in this area. And so we haven't crossed a 50% or anything like that. And where you can see that we start to have a breakdown and where we may start turning not bearish per se, because overall this is bullish price action, which we acknowledge by having this bull zone here, right? We can see that we may be losing that bullishness somewhere around 50% of the retracement of this push in this area. And that's where you can see the bull zone would get violated. And so as long as you're above that bull zone, there is a good chance. Look at this wick right here. I don't know if you can see it easily on your screen, but if you take a look, right, just in this area right here, you can see this very strong wick right here on the daily. You can see this strong wick coming right off of that, and that suggests that that strength is really being resilient there. Now, this bull zone can be defined in multiple different ways. Again, you can use fibs, you can use, whatever type of indicator that you want. But in my case, I really do strongly believe in these type of fib zones on the RSI as just a good indication of the health of the chart. And so when we're looking at the RSI and I see that that's confluent with this wick that just is driving up across this resistance area that I thought was going to be resistance, I can see that that is strength, that is a bull zone, and shorting above the bull zone is, you do that at your own risk. Now, if we lost that wick, then you could say, yes, this area is starting to act like it was, originally considered to be, which is this resistance area. You can see this red kind of band that I have. I expected us to perhaps get at least a hiccup here. We did. We bumped our head at the top of it, and then we had a pullback, but it was a very shallow pullback, and then just showed so much strength that we had to consider everything that I have just mentioned to our current candle. And of course, these levels will change day by day depending on how our current candle is presenting. But let's just say that we did lose that bull zone, and now we have some type of validation that this area is resistance again. Okay, we've lost our hold on the chart to the upside. We've lost some momentum to the downside. The MACD traders are now turning against us, and we've lost this bullish wick. Then we can consider that we're probably going to fall to the next relevant zone, right? The next relevant zone that I have here essentially aligns with this, this rising wedge, which typically can be a bearish pattern just by itself. Okay, we have to consider this other price action, but just by itself, a lot of people might just draw a rising wedge, and they should consider that it could break down to at least its, its mid trough area, kind of here, right? And this corresponds to where we actually see strength coming into this range over here, where you moved out of this range, right? Just up, down, up, down, up, down. You're making higher lows here. You keep pushing against the top of this range. You ended up pivoting around this key inflection level, which we used as resistance in the past. You secured it and held it, right, as strongly, and then this entire move, right, this entire just ballistic move to the upside, just surged off of that, and that's what I call big alpha energy. Now, if you were going to do some complex mathematics, okay, it's not just something that anyone can do in their head. If you're going to do a little bit of math and you're willing to sit down with the chart and do the math, or if you find yourself with a couple of these indicators, what you can do is you can get a DMI or you can get an ADX, something like that. And for example, on the ADX, you might be looking for a strength of at least 15, a strength of 20, if you're conservative, a strength of 25. And you may find that your zone is going to line up here. In other words, the strength of the move to the upside, which this is all upside movement, really got confirmed. Got confirmed by the ADX or whatever intensity, right? Whatever strength of the move indicator you would like to use. Um, that's going to be confirmed in this area, and we can see it in price action. Now, I'm sure that ICT traders and smart money concepts and Wyckoff traders and all of these guys who basically are learning trading methods from somebody else. Okay, I'm sure they have uniform terms for this. Now, I apologize. I'm somebody who created my own system. I'm somebody who looks at the charts and I create a methodology of my own that works for me in trading. And what I'm doing is I'm sharing these levels with you so that you can be informed as to the same levels that I have when I trade and where we might expect some type of a bounce, where we might expect some type of a breakdown, and where we might find strength to be preserved in the chart. And as long as we held this neutral point up here, which is essentially the pivot below the bull zone and below the major range below it, right, where we just kind of continued to break up after these wicks over here. Okay, you can see we flipped this zone over here, and we're now in this kind of outer space zone, and that's bulls being in charge. Underneath that, if we were to retrace it, that would bears being in charge. You could see that that would be a quite bearish fib, right? For you Fibonacci traders, that would be quite a bearish fib for you to get all the way back down here, right? It would be like an 786 or an 886 or something like that, where you would end up just kind of retracing this whole move. But you wouldn't say that the chart was broken, would you? Because overall, you are still above this area, right? You are still above this zone. And as long as you're maintaining the breakout of this zone, right, this range here, this kind of a trend up here that was bullish, you can say we still have the strength of the move. And bulls are clearly in charge if they hold this line. Now, where it gets ambiguous, right, where it gets ambiguous is if you had that breakdown and then you started to just chop in this area, right? Let's say that you had this fall and you started to chop in this area, and price can do whatever it wants to do, right? But you start losing this area, then most likely you've lost the strength of this whole move, right? You've basically put bears in charge, whereas you put bulls in charge over here, and so you have broken down from the neutral point of control. That's what it means. That's what a neutral point of control means, and we can see it in price action. So look, this stuff isn't necessarily intuitive unless you stare at candles as long as I have, right, in order to develop this system. But I want to show you in price action why these key inflection points are important. And keep in mind that we're doing this analysis on the daily. There may be variance, and there can be significant variance when we look at the weekly or when we look at the 1 hour, right? If you're doing intraday trading, then probably what you're going to be looking for is a 1 hour chart. My daily chart is essentially to give you a guideline over multiple days. And you can see that this chart entails everything from back here all the way to the top of this new range that we're in, and then also to the inflection point that we're currently testing. And so this will continue to be valid for multiple days, even though I can fine tune and finesse the chart with new price action data, right? Because where this candle closes, that's going to change where we add momentum, where we hold momentum, etc. And for example, the add and lose momentum level could be on top of us, right? If we end up having the chance to add momentum, for example, we have this bullish engulfing on this candle, then we may have to rethink where the pool is, right? And that can redefine our entry. We're no longer looking for a short, perhaps, right? Or we're no longer looking for a breakdown. We might be looking for where we could have a continuation. And that's going to change how we look at where the volatility pivot is. Now, I didn't ignore the volatility pivot. I will get that in a moment. I just want to follow this more obvious price action here. And so, look, if we do lose the neutral point, okay, which is essentially where this breaks down into this next area, and if we lose the big alpha energy line, which is essentially where the intensity of our move was validated and even confirmed by some type of an oscillator, perhaps the ADX or the DMI. You can take a look at these different types of strength of move indicators, and you can understand what that could mean. But if we lose that strength of the move, then it's very easy for us to fall back to the bottom of this range, okay? And that wouldn't be necessarily unexpected. Okay, you can see that our range here is like this, and then simply we made higher lows and eventually popped off as described. But should we be coming from the top down and just break through this stuff and lose that intensity to the upside, then yeah, we could have some wobble, but we could also have an opportunity to retest the range that we're now breaking into. And I don't need fancy terms. I don't need some type of fancy schooling or school of thought to figure this out. I can figure it out by myself. And if you want to just zoom in and see, is that bear zone valid? Is there any validity to that bear zone? Well, look what's underneath us. And you can say, well, why is the bear zone here? Well, we can just create some type of pivot, right? Some pivot based upon price action where we ended up flipping it and holding it before launching it, right? So here's where we pivoted. We can just put that bear zone somewhere in the center of that price action and feel reasonably confident that that's the bear zone that we're talking about, okay? In terms of lose this and make some confirmation candles underneath it. Don't just pivot around it, but make some confirmation candles underneath it the way we made confirmation candles on top of it, reclaiming that level. Then what you can see is that we could easily retrace this candle all the way down to, perhaps this 30,000 or whatnot. So guys, I hope that that gives you a good overview of what these levels mean and how they are important for one another in terms of where price might be oscillating around, how does it get confirmed, and if it loses a key level, on a closing basis, where you might expect it to move next, right? We just would expect that this push up here being engulfing right at my hold momentum level, and I created this level before this candle even existed, okay? I created this level before this candle existed. We can see that it pushed up, it engulfed, and so we might expect that it's going to come and tag this volatility pivot. Now, why did I choose that volatility pivot essentially in the 50% of this wick? Obviously, it rejected right here at the top of the wick, and then it closed down here. And so there's kind of this 50% area. Is that what's significant? Well, let's go ahead and go on the 8-minute. And as long as we're holding this area between the hold momentum and the volatility pivot, then we are going to essentially be taking a look at what type of price action is going on here. And we can see that this was basically just like a 1-minute wick up here. And the lion's share of our price action, it could be a little bit even more fine-tuned on the 5-minute or whatever. But in terms of just really fine tuning this range, the pivot that we need to overcome is somewhere around 44,500. That's the top of this basically choppy 8-minute range up here. And yeah, I mean, if we flip that, that would suggest that we're going to again have a bias to the upside, because all of this contraction that you see here will be moving into expansion, right? It'll be moving into expansion. So let's say that, I mean, let's just say that we have something like this, right? There was this type of, we come from some type of accumulation. They start to distribute on us, right? There's some type of, kind of capitulatory kind of a creek thing going on. We start to perhaps jump the creek. We're starting to show a couple signs of strength here as we're building up our higher lows. And, eventually we flip this area, taking out the price action back here, just kind of ignoring this wick, which was just kind of a flick up there, right? It wasn't really where price was traded, but just maybe even that was just one institution or something. But anyway, if we get above this price action and kind of hold above that, or just in generally are pushing through it, we can imagine that our stochastics, right, which might be oscillating in this area kind of up and down, that they are going to have, for this entire range, they are now going to have a positive bias, whereas underneath this volatility pivot, they are going to have, on a higher time frame, right, not on the 8-minute, not on the 5-minute, on the higher time frame, we are going to have a bias to the downside. So look, push up, right? This is where you would establish that volatility pivot, bump your head, your oscillators, right? Your stochastics, just think in terms of math. Stochastic is a mathematical term, right? So in terms of your stochastics, you are going to have a bias to the downside if you don't break and hold price action above there. So rejected, 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 getting rejected even lower. Obviously, this is distributing. Obviously, there's a little bit of reaccumulation here. And now we're looking, do we have signs of strength, or do we break down and lose this hold momentum level? In other words, showing some type of signs of weakness, right? And so, I'm just trying to put a little bit of Wyckoffean terms in there for those who may look at price action in a different way than than what I'm presenting in terms of momentum and volatility. Now, how can we trade this? Because we have a key level, but we also have price action that is essentially inflecting, right? It never actually does anything to solid here. Well, guys, this is the same problem you have with support and resistance, okay? You can get deviations under support and resistance. You can chop around support and resistance. You've never lost support and resistance unless you start, for example, on the daily, you may want to see a couple 4-hour candles closing underneath your daily support if you want to say that you lost that support. Now, some people may wait even for a back test, right, of the breakdown, quote unquote, retest of the breakdown to see if they should be going short, because you just never know. A push down that isn't validated by a back test that makes, an additional push down, you just don't know. And so you have to accept that any key level, including support and resistance, is always going to move in this kind of simple harmonic motion, this kind of oscillation, which is essentially the war between bulls and bears, buying and selling, right? And that's all it is. It's the fear and greed that's just kind of chopping around a key level. And if it was a straight line, if it was just very, very clear, then every one of us would be multi millionaires, because we would always get it right, because it would be 100% clear all of the time. Instead, what you're doing is you're looking at the fog of war and you're making an assessment. And so for the assessment purposes, we're using the daily chart to bring clarity. So if we're using the daily chart, now, right now we've cleaned up a lot of that noise that might exist on the 5-minute. And so you 5-minute traders, you might be frustrated by my hold momentum level. But if you're on the daily, nothing. Yeah, we had a little wick. We closed at or above that hold momentum level, right? Which is basically established there anyway. We didn't lose any additional momentum. Yeah, we had price action that chopped around. This is our fog of war kind of area, right? Because this is the level to lose, right? This is the level to lose. This is the level that we could be re-entering. Just like this above here is where we could be re-entering. This is our level to gain. And we didn't. We're just going sideways here. We're just holding our momentum. We've got as of this, recording, we have a lower high here, and we are just essentially going sideways in this little territory. So, in a nutshell, there's nothing to say on the daily basis. Now, again, where the front running may come in, you can go down to the hourly. And let's say that you wanted to throw on some EMAs, right? You wanted to throw on some EMAs to figure out what's going on here. And you can see here, right? You can see here that let's just take the 20 here. Then you can see, well, as long as we're above the 20, which we often get mean reversions to, then we have to suggest that on a momentum basis, this is actually bullish. Here we broke down, we were under the 20, but we ended up using this area as support. You can see this kind of wick down here, pushed all the way back up, so buyers are still in this area. You can see we broke down again, but we immediately pushed back up. We just kept oscillating along this area. And again, this may be additionally a function of being in that bull zone. Just lots of buyers getting ready to buy every pullback. And you can see that we had to go another go. We weren't able to reclaim this area up here. We're on the 1 hour now, even though we're analyzing the daily chart. And we're starting to acquire this little bit of a squeeze. One last test of the lows, and then you can see that we ended up crossing bullishly. So are we going to take this trade to the downside? Not necessarily when our EMAs are squeezing to the upside at the hold momentum level. This is going to imply that it's a little bit risky there. Now, if we had a strongly curved EMA, so for example, let me get this brush tool. If we had done something like this, right, and price action was kind of chopping like this, and we had price action that was about to break underneath this while it's respecting this 20 EMA, basically the Bollinger Band midline, then we could expect to trade at least to the other side of the pool. And so what you might do is you might set a stop above the previous wick high, wherever that is, because this is a hypothetical situation. We bounced here, so I can't give you that for this particular pool. But you might set it above a significant wick high, and then you might trade the range of this pool, and then you could do a 1-hour trade off of this pool. Essentially, what you would be doing is trying to front run the breakdown underneath the add or lose momentum level, because we're still above the general continuation. And so what might happen is that you just cross the pool. While you're crossing it, you could move your stop loss to break even. And then if we get rejected somewhere in the 50%, which is always kind of an area that could just suddenly reverse, just the nature of the way that people trade. Most people like to take some profit at 50%. And so if we do see a strength coming back in the chart, you could abandon that trade, or you could take a little bit of profit at a 50%, or you could, just wait to get stopped out as you would have here, or you could just hold the trade to see if it eventually pushes through the other side of the pool. Now what you have, if you are able to push through the other side of the pool, you have the loss of another key level, and this level is extremely safe because now we're talking about this zone again, and there's a high statistical likelihood that you are going to drive into this range and retest this range. Now we can see here on the 1 hour that we do have a 200 EMA down here, and you can see we're kind of like gliding above that 200 EMA. Here's the 300 EMA. And so this isn't necessarily the play that you want to take. And oh, look, those like a grandpa EMAs, right? Those super strong EMAs, they do correspond with that bull zone. So that does suggest, even if we had wicked down here, there's a good chance that bulls were going to defend that bullish control zone on the daily, even in 1 hour price action. So that level was important. Okay, that's what I'm getting at. This level is important for you to know. You don't have to just wait for the EMA to crawl up. We can see it over here. Okay, we can see it in advance. The EMA was only down here when this price action was being formed, but we can apply that level using intelligence, using price action in advance. We don't have to wait for the EMA to come up to us. We can plot it in advance so that we have some type of trade idea. So had we broken down from the hold momentum, and we did attempt to, right? We did attempt to, that you wouldn't have been wrong for front running a short here. Now, it's a matter of philosophy if you want to be shorting in a bullish control zone, but you wouldn't have been wrong to be shorting right here, and then quickly with a very, very tight stop loss, and then moving your stop loss either into profit or at your entry as soon as possible if you're going to attempt these type of front runs. And then you would have been validated if we crossed the bottom of the pool, because essentially we're clearing the fog of war. But the risk that you're taking, and everything has a risk, is that in this foggy area, okay, in the momentum pool, really you haven't added or lost anything. You're just kind of oscillating, between these two ranges. You really don't know with any high confidence that you're going to continue one way or another. But what we did is we reclaimed this multiple times, and you could suggest that after holding this multiple times and pushing up off of it with this EMA squeeze, that there's a better chance that we're going to attempt to retest this volatility pivot rather than drive down. So again, for this particular setup, we had the warning, this is the bull zone. Maybe you don't necessarily want to be shorting yet, right? We can see confluence with our EMAs, check, check, right? We do have support there. We saw how we can derive a volatility pivot. We have a little bit of resistance over our head. Now we have a little bit more harder resistance up at that $48,000 area, which can be extended to, basically the low 50s. We can talk about that later. But yeah, and then we just have this kind of foggy area. So let's see. Yeah, I think that pretty much summarizes that. Now, if you did break through this bull zone and just got through these Big Daddy EMAs, then there is a good chance that you could have a high-powered squeeze to the downside that could cover this range easily. And depending on how sharply turned your EMAs get, then that squeeze with the 20 could be so powerful that it could just break this momentum, pardon me, the intensity to the upside, just kind of completely negate it. The same way this squeeze right here, and this is going to look different on different time frames, but essentially you got a squeeze to the upside over here, and this is where the intensity of the move came into. You would essentially start to generate an intensity to the downside, and then that intensity would have to be updated and would now reflect that kind of bearish intensity as opposed to this bullish intensity, right? But if we did just lose this area and just kind of wick down here, like let's just say we did something like this, you know, that's really no harm, no foul. We kind of had a little bit of a fake out. The market makers maybe reclaimed some liquidity or something, and we just pushed on, and this just turns into a bigger range than we thought in terms of what we're dealing with on the daily. And so there's your price action perspective. I don't want to go too long into this, but I do want to just communicate what these things mean and why they are significant, and also why it might not be the best to be shorting in a bull zone. Whereas, if we have an update, we lose the bull zone, we get under these 200 EMAs and 300 EMAs on like the hourly, then if you're an hourly trader, right, we have an hourly chart, maybe we could figure out something that makes sense down here for you guys. But yeah, for right now, I'm just looking on a daily basis. We continue to push on a daily basis. There's nothing wrong with this right here. We're holding our momentum. We haven't lost any momentum. We haven't lost our bullish control zone, and we have a lot of buffer room to still for bulls to still have the advantage, and they have the intensity of the move ever since this squeeze over here. Let me see on the daily what our EMA is going to be looking like. Yeah, so you can see this kind of squeeze that happened here. Now, if you were going to show some weakness, if you're going to show some weakness in the charts, you might hit an area like this, right? This is a very typical kind of formation. And then where you would see weakness is if these EMAs up here, right, like the 4 and the 9, crossed the 20, which is also the Bollinger Band midline, and then you might see something like that, right, if it's trying to reclaim this area, or you might just have price action just kind of capitulate, even further, perhaps to where it has support lower down, right? So yeah, okay, there's the theory of how I'm driving these key levels, what they are based on, and also how you can trade them. Now, we might consider that the risk to reward trading off of this particular setup isn't that great, but on an informational basis, it is good to know where these zones are. Some days we may have significantly larger pools. Let's turn off this one. Let's just kind of zoom out, see if I can find anything for you. And let's go ahead and just take a look at some of this older stuff. Yeah. So here you can see, let me just clean up these scribbles that I have here. Yep. Okay. So back here, right? You can see an older pool that I had when we were just in this area, right? Price action would not have been moved on yet. We're just in this area. And you can see that we were just pushing into this area, so we had to hold this level. And I suggested that this would be the volatility pivot because probably some price action over here on just on a really granular level in terms of price action and candles. And so I designated that as the volatility pivot. We never crossed the pool, right? Sort of like what we're doing right now. We never crossed the pool. We essentially bounced off of the volatility pivot, we reclaimed our hold momentum, and that suggested above the volatility pivot, we had a volatility bias to the upside. Above the momentum pool, we had our momentum continuing to the upside. We had confirmation or confluence with our EMAs, where they later started to squeeze to the upside. They found support on the 20 over here, and then you can see the rest is history. We just continued to push up. But this pool would have told you we didn't have a breakdown. We didn't lose momentum. We didn't lose the MACD traders. We didn't lose the bullish control zone. This was our buffer zone, right? This was our kind of like emergency buffer zone. This was our fog of war. We're just not 100% clear. And then reclaiming this is where we showed our strength. And so above the pivot, above the pool, we can consider that a longing opportunity when we have a shift in momentum. And what would a shift of momentum look like? Because this is going to be continuation from a lower pool, which we would have already entered in. But I'll show you what a shift of momentum would have been looking like. So if we had pushed up here and we had come down through the pool on our first drive, right? Just when we're establishing this kind of zone up here. And if we had just come down, let's just say that we had tested the 20 here. We tested it over here, but let's just say that we had tested the 20 over here, right at the bullish control zone, right? We held the bullish control zone, but we weren't sure if we're going to get general continuation. We pushed up through general continuation. We got the MACD traders back on our side. Then this entry right here at the lose momentum level would have been us adding momentum back to the upside after we had lost it. And that would have been our front runnable fresh long, okay? Yes, you could take a long here. Yes, you could take a long here. But ideally, you were already in it from a previous momentum setup because this is just the fog of war and this is kind of like a late entry. And a lot of experienced traders will understand that. What I want is a shift of momentum where we broke down, we found strength, we proved our strength, we pushed back through the pool, and then right here, right here is where we're going to take our long. We're going to set our stop loss somewhere underneath this general continuation. If you're really aggressive, you believe this thing can just keep going, you could put it under your bullish control zone because most likely we're going to use that as an inflection point anyway. You can set it at one of these inflection points underneath it, maybe 50% between the next level, or you could use a significant wick. For example, there was a significant wick on the upside up here. If you had a similar wick down here, right, you could use that significant wick. You bring your stop loss back up to entry when you start pushing into the pool. And then once you reclaim the volatility pivot, there's a good chance you're going to continue. Again, above the pivot, above the momentum pool, you're likely to continue your long, and that would be the one that you would want to hold until you designate some type of resistance levels where you want to take profit. Now, because we did not break down from momentum, we did not lose momentum, we did not violate the MACD, okay? This was just one continued move from an earlier area. And so I'm just trying to teach you these principles in terms of how I would trade momentum safely. Yes, you could take a long there on the reclamation and the confirmation of that hold momentum level above the pivot because everything's in your favor, including the EMAs, but you're going to be a late long. That's all. Okay, that's it. You're just it's like your second entry. That's all. Let's go ahead and take a look at some other things that I may have going on here. Let's see. That's a daily. That's another daily. That's up there. That's another one. Let's see. Yeah. This is one I gave to Unity where we basically captured the pool, we captured the pivot, and then we rocketed off of that one per my the biases that I describe. Okay, yeah, let's find one down here. Okay, so here we can see this was a daily that had a very similar setup to what we're seeing right here. You can in our current price action, you can see that we did lose our hold momentum level that was probably established over here. Then we dipped down, but we held the bullish control zone. Okay, we held the bullish control zone. So again, short at your risk inside of the bullish control zone, we held it, and then we reclaimed the hold momentum, and the rest is history. Above the pivot, above the pool, the rest is history. Okay, boom, right? Boom. Okay, let's go ahead and take a look even further back, right? Maybe we have something over here. Yeah, here, look at this one. Okay, so here you can see that, let's see, let's go to the 1 hour. Now, this was an interesting one because we did violate the pool as we had established it somewhere around this price action. And so what you can see is this momentum to the downside. You can see a strong drive of momentum to the downside. We establish our pool using the metrics that we've clarified as valid, right? Valid pivot levels. We actually didn't get any type of a clean entry into the pool, right? Until we got past this chop. Then after this chop, we started to push up. We started to change, right? This was a downward momentum. You can see we have a higher low. We have a higher low. We're starting to get a little change of momentum there. We pushed into the pool. And what did I say, right? You can front run the move there. You can front run the move at that pool. And you can see the pivot and these EMAs on the 1 hour are crossing through the pool. So there's some chance that we could get rejected or pulled back into our downtrend. But anyway, we can take a long off of that zone right there. And so that could have been a long. We would target the other side of the pool as our first TP1, and then of course we could have some type of a moon bag in case we flipped this around and went just a supernova through the bullish control zone. But essentially, just for a scalp, we re-entered the pool on a shift of momentum, and we could target the other side of the pool. Boom, we got that other side of the pool, and then of course we would want to take our profit there. You'd be out of your trade, and your moon bag would probably just get stopped out, right? Because you put your stop loss back at entry. This ended up being just a spike, but let's just take this the next trade possible setup, because it didn't end there. We pushed out of the pool, right? We pushed out of the pool. We re-entered the pool, and so that was our short opportunity. Okay, guys. So we had a shift of momentum pushing up. We got rejected at this add lose momentum. We re-entered the pool. That re-entry to the pool was a possible short front run. As we entered the pool, we also crossed the volatility pivot, and then we broke out of the pool. So now we're under the pivot, we're under the pool, and essentially that's full permission, it's full validation of this setup. And so you're going to want to continue that trade, even though you did a little retest right here. You're going to want to continue that trade. And where would you target? Well, hey, look, there's our next key price level right here. And that's exactly what we tapped. We continued to just chop sideways off of that. We got a little bit of a reaction off of it. We retested here. We rejected off of it. I really wouldn't consider, because this is even a wick on just a 1 hour, so there's nothing really significant here. So essentially, we're still just pushing negative. If you did leave a moon bag after taking your profit right here, you're going to take profit on this side of the pool, TP1, TP2, your moon bag. You may have just left it in, see what it's going to do. Your stop loss is going to be up here at entry, right? Because that's where we move it to entry. That's why this is the front runnable move. Whereas if you shorted from here, you could easily get stopped out. right? You can see how you can easily get stopped out if you moved your stop loss here. And you didn't actually return. You didn't return to your entry, so you never got stopped out. Your moon bag is still going, right? And you can see that we pushed down to the bearish control zone. We also did it over here, but I just wanted to explain this kind of retest there. Where did this end up ever getting stopped out in terms of a short? Well, you took TP1, right? You entered here, you took TP1, you took TP2, you left your TP3, your moon bag, okay? You could have a TP3 down here, but you might have a moon bag as well, right? And you're still in this short. You have never been stopped out using this method. Not stopped out, not stopped out, not stopped out, not stopped out, still in your short, still in your short. And, you know, if you're in the extreme bearish control zone now, you're kind of getting greedy, right? And so what you can see is, you know, most reasonable people would probably take their profit already by now. But had you left that moon bag, you can see once you started to get this rounded bottom and you started to make higher lows, you probably want to get out of that, right? Probably want to get out of that just on price action basis. So for your moon bag, it's a moon bag. You're gonna have to control that, because if you're never gonna take profit on it, then you know just the way price action works, you're probably gonna round trip it eventually. But yeah, I mean this would have been a highly successful short, and so just from this stupid little wick off of this momentum pool, that trade, right, for your moon bag could have been as much as 17% on BTC. And let's see, you know, let's just say that we do something like this, right? Oops, short position right here, right? We have maybe our stop above that kind of wick area that we had. You can see it's also above these wicks, so that's fine. And then, you know, we would be targeting across the pool, right? And that may not be a good enough risk to reward to you. Well, let's put this down to the wick, right? We can choose this wick if you want. See, that's a 2-to-1. Now you can choose the wick that you changed momentum off of. Now that's a 3.75 a risk to reward. So, you know, if you're a scalper, that's reasonable, right? This is a 0.29% stop loss. 0.29%, and you got an 18% move off of it on your moon bag. You got a risk to reward of basically 3 to 4 off of that move. And if you had been stopped out, you would have lost 0.29%, right? But if you hit this target down here, because what we really want is to lose the pool, right? That's like our goal, right? That's our real goal. The conservative thing is the TP1 at the other side of the pool, but you know, our goal is to get at least to the next key level, and so that would have been, you know, a risk to reward of 14, right? 1 to 14, and that's a pretty good risk to reward. Okay, that's a pretty good risk to reward using this method. Guys, let's just go ahead and just, again, I'm just picking like random things on the chart just to try to find it and try to explain to you how this system works here. Let's go ahead and see, what is this one, right? Just some random one. All right, what is this one? Okay, this one's a good one. This one's a good one. You can see here that, you know, let's see. This pool would have been established somewhere over here. We had our momentum strongly to the downside. This would have been too early to enter because we were just creating the pool. And so we would have just waited for some type of a pullback. You see we got this higher low that implied a shift in momentum. This is our momentum to the downside. Lower high, lower high, lower high, lower high, higher low. Shift in momentum. We re-entered the pool right here. That's your front runnable level. You can put your stop underneath this wick or whatever wick you want to put. If you just want to control your risk, you re-enter the pool. We're going to target the other side. We got that. Now you're going to target the next key level. So probably this neutral point of control. Sometimes we just cut through it like a hot knife through butter because it's literally just the 50%. It doesn't really say anything about strength. It's just a level to keep in mind. It's not like the bullish or bearish control zone where you really see high intensity. So you might choose to pick this big alpha energy, which it does show intensity, right? And so, as I mentioned, by the DMI or the ADX, depending on your preference, right? But we can calculate that differently depending on different setups. But anyway, you might target where the intensity of this move might get flipped. You can see this was actually ended up being a nice flip in terms of the intensity. We got that intensity to the upside, and you could have taken your profit there. If you had left a little bit of a moon bag, right? You had your TP1, maybe a TP2, maybe a TP3, and then you left a little bit of a moon bag. I'm sorry, your moon bag got stopped out this time, okay? But just in terms of this pool, based upon our entry, we got a move of 2%, right? And let's see, if we just zoom in here, we can see we had this little wick right here. For this type of a strategy where we have a very thin pool, sometimes the pools are really fat and the risk to reward is just really good on the surface level, and you can take a distant wick. But if you're gonna just do these like little scalps on the 1 hour or the 15-minute or the 5-minute, then you're probably going to want to use just a local wick because you're not going to be risking much. So let's go ahead and just get it at the entry there. Where's our stop loss? Somewhere there. And then, just across the pool, you can say that's not a play that I want to take, Sky. Okay, like this isn't a good risk to reward for me to be targeting the other side of the pool. I'm going to skip this trade, and you would be perfectly justified in doing that. But if what you wanted to do was target this big alpha energy level, or you had a thesis that we were going to have some type of turnaround in the market, you might be targeting different levels. So if you targeted here, this was your target, then you can see that you could have a risk to reward of 4.8, right? So 4 to 5% up there. And if you had a really bullish thesis, you thought, no, I think if we cross this neutral point of control, we're going to keep going. So maybe my TP1, I'm just going to risk being stopped out. But I believe we're going to at least retest the neutral point of control because we already tested the bearish control zone. So we're probably going to, pop up here to the neutral point of control. So I'm going to set my TP1 there. Then that's going to give you a 2.5. Still not great. You usually want a 3 to 1 ratio there, right? And you could say, well, what I'm really looking for, because I have a thesis of the market, is this retest of the bullish control zone, which you can see. You can see we eventually got, and look at this, perfectly pivoting around the bullish control zone when we reclaimed that volatility pivot, right? And so you might say, well, I have a bullish thesis. I believe that once we cross the neutral point of control, we're going to target the bullish control zone. And so, my TP, 2 or TP3 is up here at the bullish control zone, and that's a 13, that's a 1 to 13 risk to reward ratio. And this is going to be your risk management. Okay, I can't do that for you. And if you really have that thesis of the market, you may want to bring your stop loss down to these wicks down here, right? Just under them, because you have a little bit of equal lows down there, which they might try to target. And so this is going to reduce your trade to a risk to reward ratio of 1 to 6. But that's going to be your setup. Now, once you launch, you can bring that to your entry, and you can lower your risk if you want. You're just going to increase the risk that you get stopped out here. Had you left your stop loss where I suggested, you be targeting the bullish control zone because you're within your risk to reward ratio, then you would have actually hit your take profit level. So again, no risk, no reward. But at the same time, you don't have to be stupid, right? Not every setup is the same. And the reason why I'm showing you this one in detail is because the volatility pivot was over our head, and that suggested a volatility bias to the upside only after we get above the volatility pivot. And that's probably why we had this hard rejection up here that took us all the way back to our lows, because the volatility pivot was over our head. And from a volatility trading perspective, we were as likely to get smacked down or more likely to be smacked down than to continue. And look, yes, we had to get smacked down. And then volatility probably modulated. We had to try the area again, and then we got the move. Okay. So again, like this wasn't the best trade setup to target the bullish control zone, only because that volatility pivot was above your head. Now, targeting this level, the big alpha energy level, that was fine. Targeting the neutral point of control, that was fine. But yeah, it was just a very questionable risk to reward there, unless you really had a strong thesis of the market, maybe based on some higher time frame squeezes or something like that, right? But yeah, that's how you could have played that one. And likewise, when you re-entered the pool down here, the volatility pivot was over your head, you re-entered the pool, and so you could have taken that short opportunity. And so on a shorting basis, you didn't get stopped out. You would have got a solid 1 to 1.3%. There just wasn't a very clear or obvious place to put your stop loss. You could put it above the neutral point of control. You can see we did get a wick that just hit the neutral point of control. So, if this was too far, you could have put it above the neutral point of control and tried to take that short. And that would have been a reasonable setup just because of where the volatility pivot was at the time. But as it happened, as you know, these ETFs and everyone have been accumulating Bitcoin, so there was just a lot of strength to the market. And so that setup was a little bit counter the overall macro trend, right? The overall macro trend, which while sloppy over here, has been extremely powerful behind it. And so when you're looking at these macro areas, yeah, you can take the chance, right? You can kind of hedge to the downside. A lot of people freaked out right here, but you're making a higher low already, and you got this little, you're flipping your 200s, right, and your 300 over here on the hourly. Just, your EMAs on the daily are probably starting to squeeze to the upside or flatten out. You have to look at multiple time frames. You have to look at multiple time frames to understand, do you want to try to take that trade because you have a thesis of the market that we're going to re-enter the bearish control zone? Or do you want to take the other trade, with a little bit more risk because you believe that there's a higher likelihood that we're going to be accumulated and squeezed to the upside, right? And then you can see this shoulder, head, shoulder that could have been formed. So we easily could have been putting in an inverted head and shoulders there. Yeah. So again, it's not just here's a line, trade it if you're above it. Here's the line, trade it if you're below it, right? Just you have to be thoughtful as well. Let's go ahead and just try to take a look at, get out the daily here. Let's try to see if I have anything a little bit older. Yeah, that has the pivot underneath us. So here's the 2-day, okay? Very similar area. Here's a 2-day chart that I made. It doesn't have to be just on the daily. I can do it for the hourly. I can do it for the 2-day. And what you can see is that we had the volatility pivot underneath us right here, okay? Based upon this price action on a granular level, we had a 2-day pivot over here. We ended up just pivoting around the hold momentum, and then we launched off of it, and we got above that neutral point of control. You can see we tapped the bullish control zone and we just rocketed off of it. So that's what I mean by when you're above the volatility pivot, your bias is to the upside, above the pivot, above the pool, basically permission to long as long as you have other confluences here. Now this one didn't have a shift of momentum. We would have ideally liked to see us drive down, tap the bottom of the pool, maybe even check back here. We already had a lot of price action there, so it wasn't the most likely situation. But we did have a fair value gap over here. So it could have happened, right? I think you guys remember at 25K, we had this big fair value gap right here. A lot of people thought that we could come back and tag that one. And had we done that, then that would have given us the entry above the pivot to re-enter the pool bullishly. We front run the move here, right? We put our stop loss just under our wicks or wherever you want, if depending on your theory of the market, to control your own risk. We take the trade to the other side of the pool, and the rest is history. Okay, we never got stopped out after that, right? Assuming price action was going to be identical. But again, like this is one where the pivot was underneath us and that supported our thesis to the upside. The previous example I gave you, the pivot was above you. And so it suggested you were going to get smacked down. And you did get smacked down. I showed that to you. The pivot was underneath us here, and it suggests that you're going to get supported. Yes, you can come back and wick to the pivot and just retest the pivot, but it suggests that you're going to get supported on the next move. And indeed, we got supported. And this thing ended up squeezing to Valhalla. All right, guys. Let's go ahead and just see, do I have anything else? Just really, you know, let's see here. I have a lot that are at extremes, but I'm trying to find one that just has an ideal setup. Let's see, it's too slender. Yeah, we didn't breach the bottom of that one. Just looked at that one. Here's one that was shortable, where you had a momentum to the upside. You basically pivoted around this type of hold momentum. This is a 3-day chart, so just ignore the all of this chop here because you're going to see some 3-day candle closures. Going to make your decision. Anyway, you popped out of it. You probably closed up here somewhere. You ended up re-entering the pool, right? There's a good chance that you could run into the bullish control zone up here. You're shorting above the bullish control zone, right? You're taking a short on the re-entry of the pool, but you're in the bullish control zone. And so there's a good chance you're going to get rejected there. It might take a couple tries, but we kept pushing down, kept pushing down. We eventually lost that support, that pivot around the bullish control zone. And then you can see that the short did end up playing out to the other side of the pool. That could be your TP1 there. If you didn't, you could, this was such a big pool, your TP1 could have been the bullish control zone itself, right? And just move stop loss to entry. You hit the bullish control zone, boom, that was a trade. You did it again, you hit the bullish control zone, boom, you took your TP1, and then over here you didn't get shorted, right? So the second entry over here, you didn't get stopped out, pardon me. You got your TP1, but then your TP2 would have been the other side of the pool. Boom, you hit it, okay? And then your TP3 could have been the neutral point of control, or it could be the volatility pivot, depending on your philosophy on the neutral point of control. I don't consider the neutral point of control to be a hard line. I consider it to be informational, but there's often wars around that area, so it is a good place if you wanted to use it as a take profit. But anyway, we cut through it like a hot knife through butter because it's not that significant, okay? And it just gives you an idea, okay, of the balance. And so you can see that where a good TP3 would have been that volatility pivot, because the pivot suggests that it would work against us, right? We're shorting, but the pivot says that its bias is to the upside. So yes, we came back to retest the pivot. This is the philosophy of this trading method. Yes, we came back to test the volatility pivot, but we weren't able to significantly close. These are daily candles, so we weren't able to significantly close underneath it on a 3-day candle closing basis. And so this was nothing. This was nothing. It suggested that we were going to bounce, right? So this was a successful trade, and that would have been, yeah, you got stopped here, you got stopped here, right? Maybe you lost, whatever percentage, depending on your risk to reward, or if you brought your entry, your stop to entry. But on this one, because you had some thesis of the market, maybe you had a bearish divergence building up, right? You saw bearish divergence, bearish divergence, bearish divergence, triple bearish divergence. And so you thought this is a good place to short, right? You had this area over here. You thought this is a good place to short. And so you wanted to keep trying the short. Well, this one, you got it. And you got a brilliant 15% move by playing the pool strategy, okay? And let's see. Let's see, short. Let's see, you had an entry right here. You know, you could use that wick high if you wanted to. Just do that. You target the other side of the pool. You know, risk to reward 2.4 if you're going to take this extreme deviation. But you might consider that that's kind of that this isn't the best trade, and that this deviation is specifically established here to ruin trades. But yeah, you know, you could do something more moderate, like the 50% of that candle, which would imply that it's going to continue, and then your risk to reward is more like 8, 1 to 8 risk to reward, and so that would have been a very good trade. And had you surpassed that 50%, then you would have been stopped out. But anyway, it would imply that it would continue to potentially engulf that candle anyway. So I think this was a pretty good setup. Now, if you wanted to have a target for the next level, then you could set it for the neutral point, which would have been a 1 to 10 risk to reward, and then you could have also targeted the volatility pivot for your TP3, and that would have been a 1 to 13 risk to reward. And so that would have been a very good setup to use there. And then again, that volatility pivot just informs you that probably you're not going to continue on this one. Okay, probably this is a good place to just get all out, and then you might take the long. And so what happened over here, right? What happened over here, we bounced off of the pivot. Okay, this pool still exists, right? It's based on price action. This pool still exists. Of course, we could update to new 3 days because multiple days have passed, right? Maybe even multiple months, but this pool still exists. And so what we could say is that, yeah, obviously volatility and everything might be changing, but we came off of this momentum to the downside. We had a change in the overall, we had a shift in momentum, higher low, right? We made an attempt here. Yeah, we got stopped out. Okay, sorry, we got stopped out. Okay, it doesn't always work 100% of the time, but higher low. We have a thesis that this pivots on our side. We have a thesis we're above this 200 and 300 EMA. We're above the neutral point of control, right? And just because we bumped our head, once on the pool doesn't mean that it's going to fail. It just means sometimes you need a retest, right? You need to double check that, right? We have this bullish pattern here, right? This shoulder, head, shoulder. So that implies that we're going to have a measured move into the pool. And so we're going to take our chance on this one. Right, that's up to your discernment, and then you can see that your entry would have been at the re-entry of the pool there. You could set up your long position to target, the other side of the pool, and maybe once again you're doing like a it doesn't really make sense to do this where it's just a risk to reward of 2, right? But you could get down here, you could take this candle and you have a risk of 3 to 4. And you can also do the 50% of the candle if you just want to get a better risk to reward. Just have to manage your stop. And look what happened, okay? Look what happened. Let's just say that we put it under the wick of this candle, just right here. You have 3.5 risk to reward, right? So we take this long into the pool. Yeah, it starts to come back, but it never broke out of the pool, right? This pool suggests momentum is continuing. And so you did hit that full move. You got that 3.5 risk to reward. And when you were pushing, right, when you made this into a higher low here, you could have just brought this back to entry, right? or now that I look at it, we had this general continuation, which is the MACD traders. Sorry, this wasn't lined up perfectly, but we had the general continuation line right here, and you could have just had that right at the right below the general continuation. Why? Because that's where your MACD traders are going to freak out. But above that level, they're going to be confident that we're still bullish, and so you have a lot of the market on your side when you took that trade to the upside. So you easily could have, if you just wanted to take a chance, you easily could have just controlled your risk by putting your stop underneath that general continuation or somewhere on the 50% of wherever this candle was, like somewhere down here. Or you could have just taken the full candle and it still would have worked. It's just you're risking that bears come back into control. But again, the reason why experienced traders would take that trade is because they would see this bullish pattern. They would see these higher lows, right? They would see that we projected into this area before, and that that we've engulfed this area, and so that implies that we're probably going to see a higher high and a higher low, and we probably aren't going to take out this area off of this type of accumulation pattern. So if we're going to show our signs of strength, and so yeah, I mean, if you have the experience, you literally could have had a risk to reward of almost 20, okay, and controlled that stop very clearly. And if you're less experienced and you just wanted a little bit more wiggle room, this candle here on the daily, or you could, take a chance at a 2. But your theory of the market is you're going to cross the pool here. You're going to reclaim that bullish control zone, and above the bullish control zone, you are going to want to leave a moon bag, and that moon bag, all right. Even if you had the biggest stop loss here, which by the way you never got stopped out, even if you had the biggest stop loss, all right. Yeah, I mean it's pretty good reward there. So that was 60%, right? So yeah, 60%. And if you had brought your stop loss to entry when you were pushing up, you could have just reduced your risk further. All right, guys, I think I'm going to end it there. Getting a little bit exhausted. I will try to find more ideal setups in the future, but that's your alpha for the day. Stay safe and happy trading.